Hey guys, I am Deric. Welcome to my channel. In this video, I'm gonna give you an introduction to investment. If you have money in a savings account, you are already an investor, because you have at least one investment to your name. An investment is any asset into which funds can be placed with the expectation to generate positive income and to preserve or increase its value. Return is the reward you receive for owning an investment, and it usually comes in two basic forms. First, current income, for examples, interest or dividend. Money invested in a savings account provides income in the form of periodic interest payments. A common stock or ordinary share also provides current income in the form of dividend. Second, capital gain. Investors often buy shares because they expect their price to rise. So buying common stocks offer both current income and the chance of an increased value, which is what we call capital gain. Next, let's compare the differences between investment and speculation. First, the purpose of investment is to generate income or profit over a long period of time, while the purpose of speculation is to make a quick profit by buying and selling assets in a short period. Second, investment is generally considered less risky than speculation. Investments are made in assets with a long-term track record of consistent returns, whereas speculation often involves investing in assets with a high degree of uncertainty and risk. Third, investment is made for the long term, while speculation is done for the short term. Fourth, investment involves a thorough analysis of an asset's historical performance, financial statements, and other data, while speculation often relies on rumors and trends. Fifth, investments tend to be more liquid and can be easily converted into cash, while speculation can sometimes lead to assets that are difficult to sell. Next, let's look at the types of investments. Securities or property investments. A security is a certificate or other financial instrument that has monetary value and can be traded. Securities are generally classified as debt securities, such as bonds and debentures, equity securities, such as stocks, and derivative securities, such as options and futures. The sale of securities to investors is one of the primary ways that public companies receive new capital for operations. Property consists of investments in real property or tangible personal property. Real property refers to land, buildings, and that which is permanently affixed to the land. Tangible personal property includes items such as gold, artwork, antiques, and other collectibles. Direct or indirect investments. A direct investment means an investor directly acquires a claim on a security or property. If you buy common stocks of a company, such as Apple Incorporated, then you have made a direct investment, and you are a part owner of that company. In contrary, an indirect investment means an investor owns an interest in a professionally managed collection of securities or properties. For example, when you purchase a mutual fund or unit trust, you are making indirect investments in the assets held by these managed funds. Debt, equity, or derivative securities investment. Debt is an investment in which the investor lends funds in exchange for periodic interest income and repayment of full amount of loan in future date. When companies or governments need to borrow money, they will issue bonds. When you buy a bond, basically means you lend money to the issuer. The issuer will pay you periodic interest for a specified time, and at the end of maturity, the issuer will repay the original loan amount to you. Equity represents ongoing ownership in a business or property. An equity investment may be held as a security or by title to a specific property. The most common type of equity security is the common stock. Derivative securities are neither debt nor equity. Instead, they derive their value from an underlying security or asset. For example, stock options. A stock option gives an investor the right, but not the obligation, to buy or sell a stock at an agreed-upon price and date. The value of this option depends on the market price of the underlying shares. Low-risk or high-risk investments. Risk is the chance that actual investment returns will differ from those expected. Simply speaking, risk is the uncertainty of receiving return. The broader the range of possible returns for an investment, the greater the risk. Investments also differ on the basis of risk. Risk reflects the uncertainty surrounding the return that a particular investment will generate. The broader the range of possible values or returns associated with an investment, the greater is its risk. For example, common stocks are generally considered more risky than bonds, because the range of the highest and the lowest returns of stocks is wider. So, low-risk investments provide a relatively predictable, but also a relatively low return. High-risk investments provide much higher returns, but they also have the potential for much larger losses. That's why we say, high risk, high return, low risk, low return. Short-term or long-term investments, which is the life of an investment. Short-term investments typically mature within 1 year, such as money market investments. Long-term investments are those with longer maturities, or like common stocks, with no maturity at all. Domestic or foreign investments. Most investments are domestic investments. That will be the debt, equity, and derivative securities of local-based companies and governments. However, investors also look for foreign investments, both direct and indirect investments, that might offer more attractive returns than purely domestic investments. Next, let's look at the investment process. Here we have suppliers of funds and demanders of funds. Suppliers are those who have extra money, whilst demanders are those who need money. When you have extra money, the first way, you can consider putting money in the financial institutions, such as banks. Suppliers of funds put money in the financial institutions as deposits, then financial institution provides money to the demanders of funds as loans. For such borrowing, demanders of funds will pay back interests to the financial institutions. The financial institutions will then pay interest to the suppliers of funds. That's why, when you save money in the bank's deposit account, you will receive interest. That is from the demanders of funds. The second way, if you don't want to deposit your money in the bank, you may consider investing your money in the financial markets, such as the share market or bond market. Suppliers of funds provides money to the financial markets through buying shares or bonds, then the financial markets will transfer the money to the demanders of funds. For receiving the money, the demanders of funds will provide securities to the financial markets. Securities mean the certificate of shares or bonds. And then, financial markets will transfer the securities to the suppliers of funds. That's how we buy shares and bonds in the financial markets. The third way, when suppliers of funds go directly to the demanders of funds, that's when private placement occurs. For receiving money from the suppliers of funds, the demanders will issue securities to the suppliers. The flow of funds may also happen between financial institutions and financial markets. It happens when banks buy shares or bonds from the financial markets. Let's take a closer look on the suppliers and demanders of funds. Governments, businesses, and individuals are the key participants in the investment process. Each may act as a supplier or a demander of funds. First, government. It includes all levels of government, such as federal and state governments, who needs huge sums of money to finance long-term projects related to the construction of public facilities and to keep the government running. Typically, government is a net demander of funds, which means it demands more funds than it supplies, because government spending often exceeds tax revenues. Second, businesses. Most companies require large sums of money to support their operations, especially for the production of goods and services. To finance both long-term and short-term financial needs, businesses issue a wide variety of debt and equity securities. Like government, companies typically are net demanders of funds, although they also supply funds when they have excess cash. Third, individuals. Individuals demand funds in the form of loans to pay for property, such as for houses and cars, and education. However, overall, individuals are net suppliers of funds. Through their savings, individuals put more into the financial system than they take out. There are two types of investors in the market. First, individual investors. Individual investors manage their own money and invest for their personal financial goals, such as for retirement and buying houses. Second, institutional investors. Institutional investors are investment professionals who are paid to manage other people's money. They trade large volumes of securities for individuals, businesses, and governments. Financial institutions are the institutional investors such as banks, life insurance companies, mutual funds, and pension funds. For example, a life insurance company invests the premiums it receives from policyholders to earn returns that will cover death benefits paid to beneficiaries. Investing can be carried out in a logical progression of steps. The following are the 7 steps in investing, which provide useful guidelines for us. Step 1. Meeting investment prerequisites. Before investing, you must make sure that you have adequately provided for the necessities of life. This includes funds for housing, food, transportation, taxes, and clothing. In addition, you should have a pool of easily accessible funds for meeting emergency cash needs. Another prerequisite is adequate protection against various common risks, such as death, injury, illnesses, or disability. You can acquire the protection through buying insurance, such as life insurance, health insurance, property insurance, and liability insurance. Step 2. Establishing investment goals. Once you have satisfied the prerequisites, the next step is to establish your investment goals. Investment goals are the financial objectives you wish to achieve by investing. Then, your investment goals will determine the types of investments you will make. Common investment goals include: first, accumulating retirement funds. Accumulating funds for retirement is the single most important reason for investing. The earlier you start saving money for retirement, the greater the chance of accumulating sufficient funds to meet your retirement goals. Second, enhancing income. Investments enhance income by earning dividend or interest. It is particularly important for retirees, as they need high income at low risk for living. Third, saving for major expenditures. For those who have a family, they always put aside money over the years to accumulate the funds needed for major expenditures, such as a down payment on a home, travel, and capital to start a business. Fourth, sheltering income from taxes. For buying certain types of investments, such as Private Retirement Scheme (PRS) in Malaysia, you are allowed to defer or avoid paying personal income taxes. Step 3. Adopting an investment plan. After establishing your investment goals, you may develop an investment plan. Investment plan is a written document that describes how you will invest your money. For each goal, you need to specify the target date for achieving it and the amount of tolerable risk. Your investment plan must be specific and consistent with your investment goals. Step 4. Evaluating investment vehicles. Now you will have to evaluate the investments by assessing the potential return and risk of each investment option. Step 5. Selecting suitable investments. Then you may research and gather information on specific investments that are consistent with your investment goals. You may make your investment selections based on some important factors such as expected return, risk, and tax considerations. A successful investing depends very much on the right selection of investment vehicles. Step 6. Constructing a diversified portfolio. To achieve your investment goals, you will need to assemble an investment portfolio of suitable investments. Through diversification, which means combining a number of different investments in a portfolio, you can earn higher returns and reduce risk. That's why it's important to construct and manage your own portfolios. Remember, don't put all your eggs in one basket. In the market, many individual investors buy mutual funds to achieve diversification and to receive the benefit of professional management. Step 7. Managing the portfolio. Once you have constructed your portfolio, you should measure the actual performance in relation to the expected performance. If the investment results are not consistent with your objectives, you may need to take corrective action. Alright, the above are the 7 steps in investing. Before making your investing decisions, you need to know the types of income for individuals. First, active income. This is the income that you can earn from working, such as wages, salaries, and pensions. Second, portfolio income. This is the income that you can earn from investments, such as interest, dividends, and capital gains. The third type, passive income. This is the income that you can earn from special investments, such as rents from real estate, royalties, and limited partnerships. Investors tend to follow different investment philosophies as they move through different stages of the life cycle. Generally speaking, most investors tend to be more aggressive when they are young, and more conservative as they grow older. Most young investors, in their 20s and 30s, tend to prefer growth-oriented investments. They stress capital gains over current income. As young investors don't have much money to invest, so capital gains are viewed as the quickest way to build capital. These investments have higher potential growth, at the same time, higher potential risk. Some examples of investments for youth stage include common stocks, options, or futures. These are basically growth-oriented and speculative investment vehicles. As investors approach the middle-age consolidation stage of life, which age 40 to 60, family demands and responsibilities become more important, including educational expenses and retirement savings. The whole portfolio moves toward less risky investments to preserve capital and a transition to higher quality securities with lower risk. Some examples of investments for middle-age stage include low-risk growth and income stocks, preferred stocks, convertible stocks, high-grade bonds, and mutual funds. Finally, when investors approach their retirement years, which age 60 and above, preservation of capital and current income become the primary goal. They need current income, such as interest or dividend, to supplement the retirement income. Therefore, they prefer highly conservative investment portfolio that provides a secure and high level of income is very important to them. Capital gains are just merely a pleasant, occasional byproduct of investing. Some examples of investments for retirement stage include low-risk income stocks and mutual funds, quality corporate bonds, government bonds, bank certificates of deposit, and other short-term investments. Short-term investments are an important part of most savings and investment plans. One of the reasons is because they provide liquidity. Liquidity is the ability of an investment to be converted into cash quickly and with little or no loss in value. So short-term investments are liquid, which means they can be converted into cash quickly with no loss in value. The primary use of short-term investments is for emergency cash reserve, or to save for a specific short-term financial goal. Financial planners always suggest that you should hold cash reserves equivalent to 3 to 6 months of your after-tax salary. Such emergency fund would be invested in short-term investments, which is safe and liquid. The main advantages of short-term investments are high liquidity and low risk of default. Risk of default means non-payment. The reason of having low risk is that issuers of most short-term investments are highly reputable institutions, such as the government, large banks, and major corporations. However, the disadvantages of short-term investments are low levels of return and loss of potential purchasing power from inflation. Because short-term investments have relatively lower risk, you can expect the returns are also lower. The returns even could be lower than the inflation rate, which causes the investors to lose their purchasing power over time. In short, the money you earn from the short-term investments may not be enough to cover the inflation. Individual investors use short-term investments for both savings and investment. As for savings purposes, their emphasis is on the safety, liquidity, and convenience. That's why saving money in short-term investments will be helpful when they need emergency cash. So, high yield is less important for savings purposes. As for investment purposes, stable return of short-term investments is important. Short-term investments are used as a component of a diversified portfolio. Investors are advised to hold at least a part of their portfolio in short-term and highly liquid securities. Short-term investments are also used as temporary outlets while waiting for attractive long-term investments. It means, when there is no other investments that are good for the investors, they can temporarily put their money in short-term investments. Investments are sensitive to the economic conditions of the market, especially common stocks and other equity-related securities. The business cycle refers to the recurring sequence of growth and decline, boom and recession that characterizes the economy. The business cycle reflects the current status of a number of economic variables, such as gross domestic product, GDP, industrial production, personal disposable income, the unemployment rate, and so on. There are three conditions of the economy. First, recovery or expansion. A strong economy is reflected in an expanding business cycle. When business is good and profits are up, share prices tend to rise. Growth-oriented and speculative shares tend to do especially well in strong markets. Second, decline or recession. Share prices always fall when economic activity is declining. Third, change in the general direction of the economy's movement. That would be the turning points of the economy, from good to bad or from bad to good. It is very hard to predict when the economy is going to change in direction. Bonds and other forms of fixed income securities, such as bond funds and preference shares, are also sensitive to the business cycle. Because they are highly sensitive to the movements in interest rates. In fact, interest rates are the single most important variable in determining returns to investors for bonds and other fixed income securities. Interest rates and bond prices move in opposite directions. So when interest rates go up, bond prices go down. But when interest rates go down, bond prices go up. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.